In the past few years, I started from zero to building a seven-figure investment portfolio. I made a lot of mistakes along the way, and today I'm going to be talking about the most 5 common mistakes that I've seen new investors made, myself included, and I want to help you to avoid them. So let's dive in. Mistake number 1, timing the market. The first mistake is trying to time the market. You know what I mean, trying to buy at the perfect bottom and sell at the perfect top. And here is the thing, even professional investors cannot really do this consistently, and here is why. Because you cannot really time the market. Behind the market is a mix of complex institutions and individual investors that easily biased towards certain events or actions. You cannot really control when and what kind of event is going to happen and how people is going to react. Market movement is completely random, and over a period of time, there might be some patterns fits into a theory. For example, resistance and support, which are basically people who bought at a certain price point and waiting for a point to buy or sell. It's human psychology, and sometimes it works, but again, you cannot really predict what are the other random events is going to happen and make that series invalid anymore. So let me share a crazy stats. If you missed just the 10 best days of the market in the past 20 years, your return will be cut in half. So if you're trying to time the market, getting in and out and missing out on those 10 days, you essentially only making half of what you're supposed to be making. And a lot of people trying to time the market by doing day trading and ended up losing more money, and for the exact same reason that they cannot really control and understand what are the random events that's going to happen that's impacting the next day or next hour stock movement. Mistake number 2, not diversifying, putting all your eggs in one basket. I get it, I've been there too. You heard someone made millions of dollars on Tesla or Bitcoin, you wanted to, but there is something what people don't actually tell you is that all the people who lost all their money is betting on one single stock because that's super risky. I was lucky though. I got out before the big crash coming and I was cutting my loss soon enough. But if I didn't do that, I could have lost my entire thing. Which leads me to my next point, mistake number 3, not cutting your loss. So there is some emotionally challenging aspects of investing. The psychological trap of holding on to a losing investment. This is something often called break-even syndrome. When investors refuses to sell a losing position, hoping it will eventually come back and sell it at a break-even price, and that's how you see the stock charts creates resistance at the top because most of the back holders who are trying to sell at that point and stock cannot go higher. And imagine you buy a stock at $100 and watching it drop at $70, but instead of objectively evaluating the situation and cut your loss, and you hold it stubbornly and thinking that I will sell it when it comes back to $100. That's a lot of people do. And this behavior often comes from loss aversion, our psychological tendency to not wanting to feel the pain and the lose of the money. The problem compounds when an investor even wanting to buy more falling stock, trying to average down their purchase price and throwing good money after the bad. But in fact, every day is a new decision point. The market doesn't really care about what are the prices you are getting in and what price you want to get out. It is up to you to decide what makes most sense to your current situation. One helpful way to think about this is to ask yourself, if I have cash today, would I buy it at the same investment at the same price? If the answer is no, that's a strong signal you might want to cut your loss and reallocate your resources. I have a 20% lose cutting rule. If I am in a position and I've been losing 20% and from research, it doesn't show the signal of recovering, I will just cut my loss there. Which leads me to my next point, mistake number 4, skipping the research. This is the mistake of a lot of investors don't really understand what they are actually buying. Would you buy a car or house without knowing anything about it? And you probably won't. But surprisingly, how many people are doing this in their investments and they have so little knowledge about what they are putting their money towards too. You don't need to become Warren Buffett that's reads everything, every single detail about the company, but basic understandings are essential. What does a company do? How do they make money? Here are the 3 dimensions of the formulas that I'm following for my own stock research. Step 1, research about the company's general business landscape and understand what they do, how they're making money, and what kind of players in this market, what kind of competitive advantage they have. Number 2 is to model the company valuation. This is a critical step to put everything that you just learned from the previous step into the numbers, and this will help you to not listen to the noise of the market, but look at your own analysis and say, here is what I believe the fair price for the company is. And last but not least is to have a trading plan. Based on your pricing model, you should get a good sense of if the stock price today is too high or too low, and you can form a plan accordingly. When the stock price is too high, and you can wait until pullback to get in, and vice versa. A lot of people were following the hype and getting into a stock at a very high pricing, which leads me to the mistake number 5 I want to talk about, chasing the hype. You've probably seen some videos or social media posts that the stock or fund returned me over 100% last year, but here's a catch. Last year's performance doesn't really guarantee the future result. Let's take NVIDIA as an example. One of my favorite stock, actually, I'm a long-time holder for NVIDIA. Since the past year, NVIDIA price has grown almost 100%, almost doubled. But now, if you look at from the beginning of the year price and versus now, it's already 6% down. So there's no guarantee that NVIDIA stock price will grow 100% year over year forever. If someone is chasing the hype, they will likely get caught at the highest price point for a period of time. So this goes back to the last point I was making, that if you do your own research and make your own judgment, you will not be influenced by the hype of the market, and you will have your own investing strategy. Next mistake, emotional trading. So fear and greed are the biggest enemies in your investment. When the market crashes, the fear tells you that sell everything. For example, in March 2020, when COVID hits, the market hit record low. But now looking back, that was actually great buying opportunities when everybody was selling, everybody was panicking. And at the same time, when everything goes up, the grade start to tell you that you should bet everything on the market. So here's the simple truth. The market just goes ups and downs, and always has and always will. The key here is to understand your own trading strategy and form a plan, and regardless of how your emotions or the noise on the market will say. So those are my top beginner mistakes in investing. If you found this helpful, please hit the like button, subscribe for more investing tips, and drop a comment down below. Hopefully, I'll see you next time. Bye.